US consumer confidence dips, but the dollar rises as a Fed governor says she's not ruling out rate hikes. Australia's May CPI is set to tick up, while consumer confidence held steady despite talk of higher interest rates. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ senior commodity strategist Daniel Hynes discusses the prospects for copper against a backdrop of falling prices and a storage glut in China.
Ultimately, the demand coming from clean energy sectors such as renewable energy and electric vehicles is still pretty strong, and we're expecting to see that drive growth in demand higher this year.
But first, in 5 and 5 with ANZ, I'm Alex Tarrant, standing in for Bernard Hickey, who's on a midwinter break this week. Global markets were mixed overnight. European equities fell ahead of French elections at the end of the week. US stocks were firmer, despite a small pullback in consumer confidence. ANZ economist Bansi Madhavani says consumers' assessment of the current situation held up, while future expectations weakened.
It is likely that consumer confidence could weaken somewhat as the year progresses, and that's reasonable to expect given that monetary policy is working to restrain demand. What we think it suggests is that it will be appropriate to cut rates once there is greater confidence that 2% inflation can be achieved and sustained.
Number 2. Comments from Fed Governor Michelle Bowman led the US dollar to rise. It was up about 0.2% at 4 a.m. Sydney-Melbourne time. The Aussie dollar was down 0.15% at 66.46 US cents, while the Kiwi was down 0.13% at 61.17. Bowman said she was not ruling out rate hikes if progress on inflation stalled. Here's Bansi again.
While the comments are on cautious side, it is important to note that they are still consistent with messaging from the Fed that further improvement in data over coming months is required for them to be able to start cutting rates. Markets are pricing chances of rate cut in September at over 70% and is roughly priced for a total of 2 rate cuts in 2024.
Number 3. ANZ Roy Morgan consumer confidence held steady last week. ANZ economist Maddie Dunk says that was despite headlines that the RBA considered a rate hike. Households' view of their year-ahead finances fell, but there was some strength in the survey.
The time to buy a major household item sub-index, that rose 5 points to its highest level since late January, and that might be linked to the ramp up in end of financial year sales events. If you've looked at your emails, you've probably seen a lot of offers from retailers as they're trying to entice households to go out and spend some money.
Number 4. Australia's CPI indicator is expected to rise to 3.8% annually in May from 3.6% in April. The core measure looks set to drop slightly to 4%, says ANZ economist Catherine Birch.
We're expecting that we'll see the seasonal monthly price falls in things like clothing and footwear and holiday travel and accommodation, which are typical for May. We're also likely to see fuel prices fall by 5.6%, so that will detract a bit as well. But on the other hand, we're likely to see rents and construction costs for new dwelling continuing to rise pretty steadily, and electricity prices should see a solid increase as the effects of rebates wane. We're also expecting another robust rise for insurance prices as well. Number
5. Malaysia's core CPI was steady at 1.9% annually in May. The headline measure rose 2% from a year ago, up from 1.8% in April, slightly above expectations. ANZ economist Arindam Chakraborty says the rise was driven by utility and transport prices.
We maintain our view that the fuel subsidy rationalization will be a one-time calibration with limited second-round effects. We therefore think that B&M will keep the overnight policy rate on hold at 3% in 2024, considering the existing wide negative interest rate differential with the US.
Arindam Chakraborty there. Now, in our bonus deep dive interview, ANZ senior commodity strategist Daniel Hynes discusses the prospects for copper against a backdrop of falling prices and a storage glut in China.
It may appear to be a fairly strong signal that demand is relatively weak, although there are some issues non-related to demand which are resulting in this build-up. I mean, certainly we've seen a slightly different build-up or cycle, I suppose, into the normal peak manufacturing season in China, and that has resulted in slightly sluggish demand for the metal in recent weeks. But there has been this discrepancy between domestic prices and international prices in China as well, which has resulted in the movement of inventory. So copper being cheaper internationally than in China itself has resulted in a lot of imports of the refined metal coming into the market, where traders are trying to play that arbitrage. So that has resulted that inventory levels starting to build prior to the real peak in demand from the manufacturing and industrial sort of season. So that's what we're seeing at the moment. Ultimately, though, we're still fairly confident around the demand prospects in China itself. Certainly, the property sector remains an issue, and I think that's something which has been well highlighted in the past. But ultimately, the demand coming from clean energy sectors such as renewable energy and electric vehicles is still pretty strong, and we're expecting to see that drive growth in demand higher this year.
And then just looking elsewhere in the world, there are some supply issues for copper in copper-producing countries. What are we seeing there?
Yeah, look, it all started at the end of last year where we saw a couple of major operations close, and that really tightened up the concentrate market. And even with the rise in prices, we're still seeing a host of producers really struggling to either bring new projects in or to maintain output at current operations. And that's highlighted quite starkly in Chile, where Codelco, the world's largest copper producer, has continued to see output decline despite ramping up their investment. And that's the result, I think, of more difficult operating conditions, but also the lack of investment in previous years, resulting in a lot of those operations really failing to operate at full capacity. So it is an issue which I think the industry remains quite mindful of, and that is why we're seeing at the moment the refiners in China really competing hard for copper ore or concentrate, and that's pushing those processing fees they charge to sort of record lows at the moment.
During the first few months of the year, we were talking about how speculators were piling into copper. What have we seen during June alongside those price falls?
Yeah, well, naturally, we've seen a lot of the shorts really build up their bets in recent weeks, and at the same time, I think the strong rally we had in the first quarter has seen some of those investors, other investors, really lock in those profits. So a build-up of shorts and a cutting of the long positions has seen that net bullish position fall quite sharply, which is understandable. I think compounding that has been the uncertain economic backdrop that we're experiencing at the moment. There's some level of uncertainty around the Fed will start to cut. We're seeing a little bit of mixed economic data come through. We've obviously just talked about the issues in China. It makes for certainly an uncertain backdrop for commodity markets and copper, and that's going to really weigh on investor demand in the shorter term.
Daniel Hynes there. I'm Alex Tarrant, standing in for Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, June the 26th. Catch you tomorrow with those Australian CPI figures and what they could mean for the RBA.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.